Ashok Tyagi, Group CFO of DLF, joins us live from New Delhi. Mr. Tyagi, good morning. Thank you for joining us. This is Nikunj Dalmia from the Mumbai studio. Mr. Tyagi, whichever way I cut and dissect your Q4 performance, things were very ordinary for DLF. Profits were flat, margins were static, and sales clearly are under pressure. Why is that happening?
Okay. So, Q4A was the first quarter, Nikunj, when the full impact of the new accounting policy was felt. And honestly, that's going to be the order of the day for the next many quarters, because all the projects that we launch from now on, most of them would be governed by the new accounting policy, in which case you would see the cash first and you would actually see the accounting EBITDA a good 4 to 6 quarters into the post-launch period. So we launched Sky Court and Ultima 2 projects in Gurgaon in the last 3 months, and both of those did not translate to EBITDA in this quarter. B, of course, as I explained on the analyst call also earlier, the issue is that we are at the fag end of a lot of the old projects that we had launched in 08, 09, 010. And frankly, those were launched at relatively lower price points, and the construction costs went up. So the residual impacts of those were also being felt. Going forward, we believe that we have the new set of launches lined up for fiscal 13-14 and thereafter. And while the EBITDA performance may still take some time to translate to the books, given the new accounting policy, you should hopefully start seeing the first symptoms of positive operating cash flow in the next couple of quarters.
Mr. Tyagi, you've managed to bring down your promoter shareholding to 75%, but due to convertible preference shares of the promoters, you might have to see one more equity issuance as well by the promoters. Can you give us an indication of how much will be or rather how much shares will be sold in this tranche, and by when can we see this happening?
Okay, so Asha, the promoter CCPS that you are referring to are not an instrument that they hold in the listed company. So in the listed company now, we are fully compliant with the SEBI norms at 75% promoter holding. The CCPSs are held in a subsidiary called DLF Cyber City Developers Limited, and there's a time till March 2015 for the promoters to convert those CCPSs. Honestly, I guess working with the promoters, we are trying to ourselves figure out what is the best solution for the promoters, for the minority shareholders, and for the company of the modus operandi of converting them. And if, one of the solutions that gets thrown up is that in some form and shape, it results in a potential dilution at the parent level, it will have to be done at that stage. But right now, I think it's very early days for that discussion, honestly.
Mr. Tyagi, one very important point. You've indicated earlier that you are going to reduce debt by 4,610 crores by the end of the fiscal. What are the assets that are currently on the block that will aid this kind of a debt reduction?
Okay. So firstly, this 4610 number, I have no clue from where it came. But yes, we have said that ballpark, we should be ending the March 14 with a debt level in the range of 17,000 crores. And now the 3 or 4 broad buckets driving that was A, the IPP, which has concluded satisfactorily. B was the final closure of the wind disposals, which we had signed off in April. Part money has come. The balance part we expect to close in the next few weeks as the respective state governments, bless the deal, because this does involve, discussion with the governments. Part C was the Aman piece, which I know has been delayed from a closure standpoint, but we believe that hopefully we are at the last leg and we should be looking at a closure in the next few weeks. And fourthly, we are also looking at, selling a couple of other land parcels. Totally, this entire bucket should add up to 5,000 crores or north of it. And that is what, gives us the confidence that our debt level as of March 14 should be about a 17-ish number. Secondly, given the pace of or the value of launches that we are proposing this year, we do believe that, unlike the last year, we should be in a position where we should be at least a cash break-even even after the land and capex outflows. Till last year, as you may have analyzed, we were operationally cash break-even, but the land and capexes were a negative drag on the operating cash flow, and we do hope to correct that going forward this year.
So will the Aman Resort sale deal be signed and sealed by the month end? Is that what you're trying to indicate, Mr. Tyagi?
The signed terms, as you've disclosed, do indicate June 30th. But, honestly, if somebody needs a few more weeks to close, and if we are confident that it's proceeding in the right direction, I think those are very micro details. So right now, I'd say that we still have a few weeks before we close the deal. And we have it signed, we have an advance, but it's a fact that the deal hasn't finally closed as yet.
So just on record, the sale of Aman Resorts is not being scrapped, is it?
No, of course not.
It's a very simple deal. Why is this deal taking so much of time to reach a closure?
It's not a simple deal because it involves, about 25 plus properties across various countries, various jurisdictions. Part B, the external macro investment climate to support a hospitality deal of the ballpark that we are talking about. The fact, unfortunately, Nikunj, is that there aren't too many deals of that size and scale happening in the hospitality sector for the last couple of years. So, hopefully as the prospective buyers achieve their financial closure, it will be an achievement from their standpoint.
Jen, just for the benefit of our viewers, how much money are you likely to get because of this deal?
We were ballpark looking at a $300 million number.
And that number will not change?
That now, I mean, the agreement that we have as of signed as of right now has that number.
So if by 30th of June, which is next 2 weeks, if I don't hear any update on Aman Resorts, can I assume that the deal is off?
No. As I told a couple of minutes earlier, we are in constant discussion with those people. So, honestly, in the next few weeks, we would clearly know what is the extent and the depth of their financing arrangements. They seem to be moving in the right direction as we speak. A colleague of mine has been meeting with them overseas. So we continue to stay optimistic on the closure of that deal. On whether it's June 30th or it overflows by a few weeks, honestly, I don't think I can commit on that right now.
And final question, in terms of a ballpark guidance, how will FY14 be different than FY13?
So FY14, we are looking at a total sales booking volume in excess of about 7.5 to 8 million square feet, totaling from a value standpoint north of 6,000 crores, versus a total sales booking volume of about 3,800 crores in the preceding year. Our annuity income this year should be, in the range of 1,900 to 1,950 crores. Slightly, positive as compared to last year, which was about 1,850, if I'm not mistaken. Across the next 3 years, we expect the rental income to, move to the 2,800 crores range with the commissioning of the Mall of India, Noida, and the further lease out and escalations in the existing rental arrangement. So that business is continuing nicely. But that's broadly what we should be looking at from a 13-14 standpoint.